Hi, I'm Greg Weldon, and welcome to Money, Markets, and New Age Investing, Season 3, Episode 12. Hoping to get one or two more episodes in before the end of our third season. We turn over in Thanksgiving. And today we're talking about the Fed and Jerome Powell. Bottom line is, the problem is Jerome Powell right now. And in terms of where I believe policy should be neutral, and should be neutral as soon as possible. I'm not saying you go there in one move, but the Fed failed to signal last week that the rate cut was the beginning of a move, a more directed, a more pronounced, a more defined move to get policy to a neutral stance. And they did not deliver. In fact, Powell said policy still needs to be restrictive. It's still appropriate for us to have a restrictive policy when he cites inflation and tariffs, and guess what? All that's true. It is. The problem is Jerome Powell is a monetary purist. I like to use the term egghead. It's not really meant to be derogatory. It's more of an academic mindset that is stuck in the classroom, stuck in the ivory tower, stuck in the theoretical world, not the reality of the real world, not skin in the game, not, this no blood, no foul thing is no way. This theoretical but take no action, this overthinking, to me, that's like an egghead. All right. And this is someone that's obviously never managed money, never traded the markets and so on and so forth. But, that's not his purvey. It isn't. He's a monetary purist, which is one of the things I kind of like about him. All right. He genuinely seems like a nice guy. I mean, there's no doubt. I mean, I think there's no evil intent coming from him. He's not a bad guy. He's an egghead. And to him, as a monetary purist, there's only two things that matter: employment and inflation. That's it. Because that's the dual mandate. That's what we're given. He even used the word exercise at one point during the press conference, as if this is what they do at the Fed, is just exercise after exercise after exercise. And while I kind of plug into that a little bit, because what I do here is what if, but I'm scenarioizing what am I going to do if I see these things start to develop and get ahead of them, to be ahead of the curve, to be ahead of the rest of the people in the markets, to maximize my expected value, my EV, for my customers and my clients. For Powell, the fact that you have a consumer cocoon doesn't matter. That you have a credit crunch and an epidemic in delinquencies on credit card debt doesn't matter at all. Deflation in real final demand for discretionary goods and retail sales matters not. The housing crisis matters not. The deflation in the service sector, 71% of the economy, matters not. It doesn't matter. The economy and the consumer matter not. Nothing else matters except employment and inflation and balancing those two things. And this is why the Fed has missed every turn. And in Powell's tenure, for sure. I mean, we're talking twice, way behind the curve, and now missing the curve again. Why? Because we don't see dramatic layoffs. And Powell even then talks about the fact that people that lose their jobs are not likely to find one because the hiring rate is so low. So he's flipping the bird, and not only hardworking Americans, anyone earning less than $100,000 a year is choking, and especially flipping off the people who can't find work. And what's amazing about all this is the Fed, in their SEPs, their forward projections for the economy, actually say this is the worst the labor market is going to be, and it's going to get better for the next 2 years. And Powell even came out and said, look, 10 people said, multiple rate cuts this year, but 9 said not multiple rate cuts. And in fact, the majority of them said no more rate cuts. And if the employment dynamics are going to get better for the next 2 years, like the Fed projects, that's it. It's one and done. It's an insurance policy, according to the worst possible question at the presser, which had to be a plant. It had to. This is such a, you would never ask this question unless you were told to ask this question. It's really interesting stuff here And we're going to break down all of it. I'm going to go through everything Powell said. We're going to go through all the data, and particularly the budget numbers, because this is about debt and the fact that you have to reflate if you have just killer debt that would wipe out the economy in boom, like that. Okay? You don't want boom like that. You'd rather stretch it, which is what we decided in the 90s, and here we are. And that's the only option. And the Fed will be faced with this option. And Powell even said, look, we got stagflation here. And policy can't do both. Fix the economy on demand side and keep inflation in check. They know. They know. But they're not willing to kind of put them on the table, on the chopping block every day, like people that you and I probably do. I know I do. Every single day. Stack them right on the table, and the chopping block is there. You never know when the hammer's going to come down. So, before we get to all that, though, because the market end of this podcast, and normally we go through the market at length at the end, there's nothing to do right here other than to wait and see the smoke clear, because the Fed has just blown out of the water this whole thought process that there's beginning of a new easing cycle. All right. I'm not even sure people have fully gotten with that yet. I really don't. I'm not sure. It's Monday morning here as I'm recording this. So we'll see. And it's going to be a long one, so stay with me. But the first thing I want to do is get back to the markets and do this first, do kind of backwards to the way we usually do this. And then we'll get to the data, and then we'll get to the Fed. Because the Fed is like, it just blows my mind what Powell said. It really does. It's important that we note it. But when we look at the dynamic over the last 3 seasons of this podcast, I went back just for fun, actually. Started over the weekend, did a little examination. Episode 2, Season 1, Episode 2, December 12th of 2022. I mean, we're coming up to 3 years ago, all right? And the episode was entitled, Silver is Dirt Cheap. Hello, McFly. All right. December 12th, 2022, silver was trading at $23.04. Said silver was dirt cheap. Today it's $42.85. It's actually above 43 right now. Since I said silver is dirt cheap, it's up 87%. 87%, over $20 per ounce. I actually said, weight your ownership towards gold until the gold-silver ratio flips, which it has since then. But at the time, December 12, 2022, I said, buy silver, buy gold, weight it towards gold, and buy the mining shares, ETFs. That was our prediction. I mean, and even asked the question, got gold? Like, got milk? Like, it's just, it's standard. In any household, you should have gold, all right? I'm not saying keep it at home, but that's a whole nother story, because you shouldn't. Bottom line is gold, December 12th, 2022, Episode 2, Season 1, dirt cheap at $17.90. And I even remember saying, like, $17.90, it's almost $2,000, seems high. Like, this is the highest price ever for gold. But throw that thought process out the window, because people will be chasing this market higher. And we said buy gold because we understood that at the time, central banks buying gold. It wasn't speculative. It wasn't Wall Street money rotating in, which you have now. And we said you would get to this point. That was part of our year-ahead outlook for 2025. We should see the rotation you're seeing now and this little bit of speculative fervor you have going on now. Wasn't the case in 2022 at all. It was central banks, BRICS countries that had to sell treasuries, take the dollar proceeds, buy gold, import the gold, which is why the vaults dried up and lease rates went up and the whole 9 yards around the bullion banks in London. And it's kind of exposed the shorts, the paper shorts, the bullion banks, the JP Morgans that own enormous short positions that they could never deliver upon if people wanted delivery of this stuff. Gold was $17.90. It's now $3,700. It's up almost $2,000, 107% since I first recommended it on this podcast. The mining shares, a little bit more late to the party. We said they would be. And we said also watch Lake Newmont, AngloGold Ashanti, and Barrick, because those are the big three. And if Wall Street money was going to move, Wall Street managers are going to buy the stocks they know, the stocks they can, validate towards their bosses, to whoever is overseeing them. Here's the stocks we own, instead of some of the more speculative mining shares, which is the ones we preferred. And we ran through them last podcast, all of them, save New Gold, which is a newer purchase, triple-digit gains since we bought them. What's interesting here is the GDX was the choice then, all right? And the GDX on December 12th, 2022, said buy it, $28.82. It's now $73. It's a $44 on a price less than 30. It's up 151%. The SIL, again, came later in terms of its performance. We liked it all along, of course. All right, December 12th, trading $28. Now it's $67. It's up $38, 136%. So, that's kind of where it's last time we took a victory lap. And then, of course, every time you take a victory lap, you know that you've gotten a little too arrogant, and the market is going to smack you square in the nose. And that's exactly what happened this past week, because I really thought the Fed was going to use this opportunity to make a shift. All right, I was looking for the curveball. Powell threw a high heater at my head. I had to duck and still managed somehow to strike out, because short the dollar didn't work out. And that was one of our bigger positions coming in. You also had, big corrections in gold and silver that were very short-lived, which is why they look really strong here. And at the end of the day, the only position I have on after last week, I still want to be short the dollar, very much so. That is the biggest trade going forward outside the metals, and the metals will respond to that, and the metals are already higher. And I actually had recorded this once. It was too long, so I'm re-recording it this morning. Worked on it all weekend. It's a good one. Get the chart pack too, because I put together an entire 44-page chart pack. All the data, the macro, the markets, and all the Fed's words, all of Powell's words, and the beige book too are in here. You really should see this. Good stuff. For free, no problem. Just email me, Greg Weldon at weldononline.com, GregWeldon at weldononline.com, one word. At the bottom line here is, where were we? It's still silver. So it's funny because taking a victory lap and crashed the car into the wall, now still a phenomenal quarter. For the money management clients are thrilled. Tickled pink. Gave back some profits because we had big profits built in these positions. I just levered up a little bit into the Fed meeting thinking really Powell would deliver, and he didn't. That's not why I'm, saying these things either. I'm saying it because I believe them. I have my money where my mouth was. I still believe everything I'm saying. Dollar short is one of the biggest positions you're going to see over the next 12 to 18 months. Let's go to the data, all right? Because the data is intriguing because, look, if there were any other thing, and again, you can even say, look, the stock market is part of the problem for Powell. How is he going to, really kind of validate, rationalize going on a new easing campaign when the stock market's at record highs? Maybe you need disinflation in equity prices before the Fed feels comfortable here. I don't know. That's a really interesting point, and I can't say that I blame them. It's a nuance here. They have an argument. It's just the problem is the argument leaves them exposed to when things are obvious in their argument. It's too late. That's the problem, and that's always been the problem with the Fed. And the market's predicting 3% interest rates. The Fed is at 3.6, talking Fed funds by the end of next year. We've seen this over and over again. And until 2022, the market was always right. The Fed was always wrong. But it's part of the Fed's job to be optimistic, right? So I understand. But in this case, I think it's become a tad, I use this word gingerly, irresponsible. Flipping off the average Joe. Jane Doe, Mom Pa Kettle, if you remember that. I'm an old black and white movie buff, film buff. Mom Pa Kettle, it was like during the Depression. They were the average family out there that were, struggling to find food. Let's look, and when inflation comes back, because it's here, and let's look at it. And I get it from Powell's perspective. The inflation numbers are daunting. But that's kind of not really where the focus should be when you have $55 trillion in debt between household debt and public debt. That's the problem. That's the difference. That's what the Fed is not taking into account in terms of being neutral. I'm not saying be stimulative yet. I'm saying be neutral here because bottom line, you can say the risks are balanced. And yes, inflation is a problem. CPI, 0.4 for the month. That's not chump change. 0.4. I mean, frankly, I went back and looked at all the months over the last decade. If you extract the 2-year period, 20 to 22, the pandemic inflation, 0.4 or higher only 17% of the time. 17 out of 95 months did you get 0.4 or higher as a monthly CPI. It's almost 5% annualized. It's huge. Right? Not only that, when you break it down, food 0.6 for the month. That's 7%. And I get it. It's not compounded. Well, it's not annual. It's not a true annualized. I don't care. All right. We're making it simple. Most people math, let's make it easy. I'm the math geek here. 0.6. All right. So let's say 7% annualized. Energy, 0.7 for the month. 8 plus annualized. And I have said this how many times over the last 3 months? Watch energy because the base effect is ending. And it is. And we see it in PPI particularly. And I'm going to go to those stats in a minute. Shelter 0.4, that's again 5% annualized. The numbers are high. I mean, they're just high. And when you look at the year-over-year rate, 2.9. It's up 60 basis points since April. It's up 60 basis points in April. And 2.9 is the second highest of the year. Food, 3.2, up from 2.9. And energy, with a 2.9 headline, energy is still minus 6.6 year-over-year. Inflation is here, and then when you look at PPI, well, at first glance, PPI wasn't that bad. It was down 1/10 for the month. Expected to be up 0.3. So everyone was celebrating PPI because it means forward, CPI is going to come down. And it was 2.6 year over year for PPI, down from 3.1. It dropped 50 basis points in a month. That's a big decline, all right? But 2.6 is not low. Don't get fooled by PPI. It's not low at 2.6. It was 2.6 in 2022, 2018, 2011, 2007, 1999, 1997, all of which presage periods of, economic turbulence. And here's the rub. You have to break down PPI because it's crude, intermediate, and finished. And crude meaning raw, basic, not crude oil. These are the stages of processing because it's producer price index, right? So you have 3 stages, and the number is broken down to 3 stages. Then you get the headline. The headline, 2.6, down 0.1 for the month. Mostly energy. Energy down 2.5 for the month. Energy materials at the finished level. And still, finished PPI was up 0.4 for the month, 5% annualized. Year over year, 3.3, up from 2.5. It rose 70 basis points, even though the headline rate fell by 50. Finished PPI rose by 70 basis points. Energy is still down 3.2 for the year over year. Services, 4%. And Powell is sitting here saying, well, the tariffs are going to be a goods issue. And services are at 4.0. In the CPI number, services, first of all, they cut the number of service CPI indexes by about 30%. It used to be 114 components. Now it's 77. That was mind-blowing, and I freaked out. I was looking, I missed something, I'm missing a page. I went back, I went through the headlines, into the footnotes. Oh my God, they reduced it, all right? So what's interesting here is 65% of service CPI indexes are above 3% year over year. The headline rate is 3.6. 3.6. PPI services 4.0. These are inflation numbers, man. They're huge. They're double the Fed's target. 40% of service CPI is above 4%, and 20% is above 5% or greater year over year. Only 28% are below target in service CPI indexes. This is inflation, big time. It really is. Now, what's interesting about it is the Fed talks a lot about inflation expectations, and Powell keeps saying, including just now, he said they're very well anchored, quote unquote, just in a press conference, because he was asked about inflation expectations. And he basically, what he did was he dismissed the Michigan survey because it does tend to be more volatile. And a lot of people think there's some issues around the politics or whatever. The numbers are what they are. If you understand where they come from, you understand what they are. And then you can deal with them for whatever value they may or may not provide, whatever partial value they may or may not provide. All right, it's understanding exactly what these numbers, where they're derived from, what they come from, what they represent. But the problem for Fed is it's the New York Fed's own consumer expectation survey that is the problem with saying that inflation expectations are well anchored. They are not at all. The 1-year inflation expected rate, all right, now this is a really cool survey, and there's all kinds of different ways to look at it. That's why it's such a valuable tool. All right, the 1-year expected rate is 3.2. That's up from 3.1 in July, and 3.0 in June. Okay, it marks the 57th out of the last 58 months to be above 3. How are inflation expectations anchored if they're 50% above the Fed's target and have been there for almost 5 years running? The 1-year inflation expectation in the New York Fed survey for food is 5.5. 5.5%. Good questions asked about food prices at the press conference. Going to get to that. Now, the Fed survey, again, very interesting because they also have a distribution, and then they have a whole kind of they have various ways to measure this. One of them is the median prediction point. Okay, it's kind of it's kind of I guess you would say the middle of where all the range of estimates are. It's much higher than the headline. 3.2 is the 1-year expected rate. The 1-year median prediction point is 4.5. 4.5. From a zero spread above the expected rate, 0 was the spread. They were the same in November. Now, 4.5 is 130 basis points above the expected rate of 3.2. It's like moving averages, too, and it means inflation is going higher. But it gets worse for the Fed because the 3-year median prediction point is 4%. Consumers are telling the Fed we don't see inflation. We see inflation double your target for the next 3 years through 2028. When you get to the distribution, and this is where it gets really, I love this data, the percentage of consumers that expect every level of inflation. Right now, and the low on these numbers was in October 24. You had October to like March, April. All of the inflation indicators bottomed during that period, and they're all moving higher now, including the expectations from consumers, as reported to the New York Fed. All right, the percentage of consumers expecting inflation to be above 4% over the next year, 1 year, was 37% in October. It's now 44%. Hello. The number expecting it to be below target has fallen from 38% to 33%. 44% expect above 4. 33% expect below target. Think about that. Think about that. And one more thing on the New York Fed. Because when you take the expectations for inflation, the 3.2 headline, let's use the expected rate. Let's play nice. Let's play conservative. Okay? And then we break it down by income. Below 50,000, which is, kind of poverty almost. I mean, I don't want to say that word, but it kind of is. It's hard to make all your bills. Let's put it that way. If you have a family, forget it. You're deep underwater every month. 50 to 100,000, which includes like the average and median income levels, 65 to 85,000, depending on which measure you look at. And then above 100,000. All right. Let's take a look. All right. Inflation versus their expectations over the next year for their income to grow. Below 50,000, inflation 3.1, income 2.5. Real income falls, deflates 0.6. Between 50 and 100,000, inflation expect 3.4. The more you make and the higher education, the higher you think inflation is going to be, by the way. 50 to 100,000, 3.4 inflation against 2.8 income. Real income deflates 0.6 over the next year. Do you think people are going to run out and go to restaurants and go to bars and go spend money on things they don't need when they expect their real income is going to deflate over the next 12 months? The Fed is kind of losing it. They're not listening to their own data. And then above 100,000, and this is key because this had been a very resilient source of the last bastion of strength in the economy, was those that earn over 100,000, their mood is souring quickly. And at 3.2 inflation, They expect their income to be up 3.2, which means no real income change, even for the wealthiest people. And in that context, let's not forget consumer credit. Okay, because revolving credit has now down $27 billion over the last 12 months. Revolving credit, which means it includes credit cards. And I've talked about the weekly commercial bank numbers and credit card loans contracting. Okay. Now, yeah, consumer credit rose $16 billion in the most recent month, which frankly sounds like a lot, but it isn't compared to where we've been. So it's still negative. And the year-over-year rate is still deeply negative. And it's only been negative on a rolling 12-month basis in revolving credit 2 other times in U.S. history. And now, global financial crisis 2009, pandemic 2020, and now. That's it. That's it. It's a consumer cocoon. It's a credit crunch. It is virtually unprecedented. And the Fed is just flipping the bird. Not only that, here's another great stat. I love this stat because it's so telling. Trust me on this because I pinned this out in 2007, big time. And man, was it right on. Okay. When you are, consumer credit is broken down into the sources of the credit. Commercial bank consumer loans have fallen over $100 billion since the end of the third quarter of 2024. Over $100 billion. That's more than 10%. Right? Finance companies down $17 billion. So, you know, you go to the bank, they won't lend you money. You go to the finance company, they're going to pay more, they won't lend you money. Where do you go? You go to the credit union. Credit union loans to consumers up $71 billion since the end of the third quarter of last year. Almost a year, 11 months. It's the only source of growth is credit unions. We saw this in first quarter, second quarter 2008. Same thing. Because that's the last place you can get credit. That is the easiest place you're going to get credit. And when we see that number turn down, that's going to be a bad, bad sign for the consumer, a bad sign for the Fed. They're not listening to their own data or any other data. And the bottom line is they stick to this 2% inflation target. The last time you were below 2% on CPI, which admittedly they're targeting PCE, I get it. But CPI below 2% the last time was February of 2021. Joe Biden's presidency wasn't even half over. 54 consecutive months above 2%. And the closest was just recently in April when you were 2.3. And now you're already 2.9. Which again, outside of the period from 2021 to 2023, 2.9 would be the highest CPI in 12 years. 12 years! And on the other side, of course, we have the labor market, which we will talk about, but you also have the elephant in the room, the 800-pound gorilla in the room, the Tyrannosaurus Rex in the room, okay? You have 11 months of this fiscal year in budget numbers. The budget deficit reported for August, $345 billion. $345 billion. More than that, we spent more than twice what the revenue was. And there are 5 months when either you did that or you were just within a couple tens of billions of that. 3 months specifically, you spent more than twice the revenue the government did. And in 5 months, it was pretty close to the same. Okay. Right now, revenue for this fiscal year covers only 70% of spending. Last year it was 73%. All right. Now, there's a lot of people out there that want to say, well, you had tariffs and that helped the budget situation is paying down debt. True. Absolutely true. $22 billion was the positive flow net from customs duties. Total customs duties were 29.5. You had a $22 billion positive flow in, okay? Compared to a $344 billion single-month deficit, $22 billion is a drop in the bucket. It's an eyeglass squeeze or drop in the bucket. Even though you had this allegedly huge, and guess how long it would take to pay down 1 year of debt at $22 billion a month? Yeah, decades. Okay, that's not the answer. And anyone that tells you that that's a big deal, is ignorant or is lying. Despite this record, and it was a record, $22 billion positive flow from customs duties. The $345 billion deficit in August was the 10th deepest in U.S. history. And all 10 of the 10 deepest deficits in U.S. history on a month-to-month basis have come since April of 2020. It projects to be the third deepest fiscal year deficit in U.S. history. In history. I mean, this is just not sustainable. We're chronic debt addicts. And this is why you're going to have to choose to reflate. You have to. Or you'll get a debt deflation, which is like the 1929 thing, the 1930s. You know, they'd rather have the 1970s than the 1930s. That's just the way it is. And over the last, since August of 2008, 426 months. This is how chronically addicted we are to debt in this country and the federal government. 426 months goes back to August of 2008. Only 36 months do we have a budget surplus. That's 8%, one of which we just recently had. 8%, only 8%. Out of 426 months, 390 months, we had deficits, 92% of the time. And we talk about Social Security. You have to do away with Social Security. You have to. All right? That doesn't mean people that are getting their benefits or they're going to get their benefits in the next 10 and 15, even maybe 20 years are going to lose them. That's not what this means. It means that some grandfather rate, or age rather, below age 40, below age 45, you lose whatever you put in. It's just a fact. You've already lost it. And I did a big study 2 years ago or 3 years ago when New York State raised their welfare tax, the city and the state raised welfare taxes. And I found that, man, young people would be so much better off doing their own retirement. You don't need the government to hold your retirement. That's ludicrous. Think about that. Do you really want to maintain Social Security? You really want to keep letting the government manage your retirement fund with their mismanagement, their irresponsibility? If this was any business, they'd be shut down and probably the people thrown in jail for running a Ponzi scheme. Come on, man. Do it yourself is the way to go. Social Security has got to go, but it's political suicide because of all the lies that politicians tell that scare the elderly that they're going to lose their benefits. I hate that. It's despicable. All right, you'll never solve this problem unless you face it with reality. Here's the reality, okay? So far this year, fiscal year 11 months, Medicare spending $2.44 trillion on Social Security and Medicare. Retirement income revenue, okay, so you're bringing money in to Social Security, right? $1.6 trillion versus 2.5 out. That's almost $1 trillion right there. It's 40% of the deficit. You get another $1 trillion from net interest cost, and bam, there's your deficit. Social Security and interest. And interest payments now outpaced by far healthcare, defense, veterans, and education. It's ridiculous. But this is what the Fed is facing. And while I have a few minutes left, because this is a long one, but I have to go through the Fed's comments. We have to talk about what Jerome Powell just said, because it's nothing less than jaw-dropping. I'm going to skip through the beige book. Get the chart pack. You're going to want to see all these charts, all the deficit charts, all the debt. All these charts are in here. And you're going to want to see the long-term monthly budget numbers. I mean, that's a really cool chart. The beige book talking about consumers being squeezed by rising costs of insurance, utilities, and other expenses from the beige book. Contacts report flat to declining consumer spending because for many households, wages are failing to keep up with rising prices. Bam. I keep saying it. That's all we're saying. From the beige book, firms are hesitant to hire workers. There's an increase in layoffs, reduced headcounts through attrition, an increase in the number of people looking for a job. That's the beige book. Problem is, the beige book on prices, bad. It's bad from both sides. I get Powell's dilemma. I just think he's choosing the wrong way to look at it. Nearly all districts, this from the beige book, all districts, tariff-related price increase. Contacts report rising prices for insurance, utilities, and technology services. All districts described hesitancy in raising prices, citing customer price sensitivity, a lack of pricing power, and a fear of losing business. Margins are going to take the hit, and stocks are at new highs. A lot of this doesn't make sense. And here's the pièce de résistance in terms of the beige book, just out 2 weeks ago. Clothing retailers marking up prices by 10 to 15%, citing tariffs as the reason. from the Beige Book. Restaurant contacts say menu prices increasing in response to increases in wholesale food prices, fuel prices, and insurance rates. And here is the final kick in the stones. From the Beige Book. Hotel prices rose despite decreased occupancy rates. How do you spell stagflation? You spell it Beige Book. All over it. But what does the Fed have to say about this? All right. And it says, the question from ABC, Elizabeth Schultz, good question. How concerned are you about the slowdown in jobs for households, especially younger Americans struggling to find a job? Well, that's why we become more neutral, is Powell's answer. More neutral. There's no such thing as more neutral. You're either in the war or out of the war. There's not degrees of neutrality. All right. And then he goes on to kind of mumble. There's a lot of mumbling and jumbling. Get the text. You're going to want to see this text. I did it out with highlights and everything. It's really cool. When you see just like he's stumbling to try and get his words off. He's not really doesn't know what to say. You know, he's basically said we cut rates, which will presumably be better for the labor market. But yeah, kids coming out of college and younger people, minorities, are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low hiring and a low firing environment. That's a growing concern for the last few months. And basically what he's saying too, by the way, is if you lose your job, you're not finding a new one. Those laid off, there won't be a lot of hiring going on. Then you're talking about the dynamic around inflation. Elizabeth Schultz, again. Well, the inflation reports show prices going up in key categories, including groceries. What will the Fed do if prices pick up more? What will the Fed do? And here's Powell's response. I'm Jerome Powell now. So what will we do? It's kind of how he said it. I mean, he was not stumbling as bad as I am right now. We'll do what we need to do, but we have two mandates and we try and balance them. All right, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What? Hold on. Stop the presses. Jerome Powell just said we can't fight the stag and deflation at the same time. We have stagflation, and he said it. He used the word. He used it. I've been saying it for 18 months. It's coming. It's here. Our tools cannot fix stagflation. We'll have to choose one. And you will choose to reflate, hands down. I bet my reputation on it. I bet my reputation on it in 2006. It was called a kook for saying the Fed would monetize government debt and print new money. Was. Joe Kernan called me a nut job on Squawk Box before millions of people. Now, I don't know, you got maybe tens of thousands of people watching. So this really kind of all comes down to, do we think the Fed is actually in the right position? And the best question came from Nick Timiraos. Now, this guy's really good. Follow him on Twitter. He's excellent, okay? Even though he's from the Wall Street Journal, okay? He's highly respected. The Journal used to be highly respected. But he asked the most pertinent question, thank you. Do economic conditions and the balancing risk no longer warrant a restrictive policy setting? Bam. Need to be neutral, 100%. Here's Powell's response. I don't think we can say that. No, I don't. We cannot say that. The risks are clearly tilted to inflation, but I would say they're moving towards preliminary equality. What the hell is preliminary equality? Again, this is central bankese, Fed speak at its finest, at its worst. And then he goes on. I would say they're moving towards preliminary equality. Well, maybe they're not quite at equality, but we don't need to know that. Yeah, you do. That's your job. Okay? And at least pretend you know it. Okay? And that suggests that we should be moving, not that we are, that we should be moving in the direction of neutral. So he says we're getting more neutral, okay, which is meaningless. But finally kind of puts it out there. We should be moving in the direction of neutral, but they're not, because they are saying still we can't say that we no longer warrant a restrictive policy, a.k.a. it warrants a restrictive policy. The risks are moving towards preliminary equality, and that suggests we should be moving in the direction of neutral, but they're not. That's the problem. And then you get the plant, the last one. Long podcast today, but this is it. Of course, from the New York Times. Of course. I'm actually just realizing that now. I didn't even notice that before. Colby Smith. I got nothing against her, necessarily, except she's a plant. Here's her question. Should we be viewing today's cut as the committee taking out some insurance against the possibility the labor market is risk of weakening? That's a planted question. Why would anyone ask that question? Unless you were directed to ask that question. And of course, leave it to the New York Times to be in cahoots. I mean, just no credibility whatsoever. And this question just verifies it, if that's what you think already. But Powell kind of exposes a major problem here with his answer, and he doesn't even know it. Yeah, I think you could say, in a way, this was a risk management cut. Because if you look at the SEP, which is the economic projections, the projections for growth this year actually ticked up a bit, and employment really didn't move. That's false. That's a lie. That is a lie. Okay, and here's why. Because employment did move. In fact, the Fed adjusted next year and the year after their employment projections to be dramatically better, much lower unemployment for next year. Next year, the majority, the biggest vote for unemployment rate next year was 4.7. Now it's 4.4. Hello? From 4.7 to 4.4. The biggest grouping for 2027 was between 4.5 and 4.7. Now it's between 4.2 and 4.4. In other words, the Fed is saying this is the worst the labor market is going to get. You're going to see a much lower unemployment rate in the future. And that would imply that they're not even going to cut rates again, that this is an insurance policy. I mean, this is why I think this question was a plan. So Powell could say all this. We need to be restrictive because inflation is a problem, and we expect the employment thing is not going to be. That's what they just said. And here is the end game. Here's one of his last comments, okay, when he was asked about, the dot plot. He says, so you have seen that we have 10 participants out of 19 who wrote down 2 more or more rate cuts for the remainder of the year, but 9 who wrote down fewer than, and in fact, in a good number of cases, members wrote down they expected no more cuts. If you think the employment market is going to strengthen from here and inflation is too high, one and done could be what this was. I really beg to differ. I think the Fed, doesn't want to telegraph this because the stock market's at new highs. I think there's a lot more nuance going on here. But at the end of the day, if you just take it for face value, Jerome Powell is just flipping off the average Joe, Jane Doe, mom, pop kettle, and the market. Because the market's expecting 3% Fed funds by the end of next year. According to Powell, it could be, the average is 3.6. It's a 60-point difference. And I'll tell you, until 2022, this was always the way. Because I get it, the Fed needs to be optimistic. It's part of the thing. So, yeah, of course, let's say the employment market is going to be great because this way it instills confidence. We've already seen, Powell asked about inflation expectations. He basically said if we stick to our 2% guns, people will believe it. We can talk down the market. Really interesting stuff. The bottom line for me, though, is this does put into question, at least in the near term, just the Fed's part of this in terms of the dollar depreciation theme. And maybe that's what they want to see. Maybe they want to see a little stronger dollar where it can take some of the pressure off inflation if it is coming, which of course it is, and they're not going to be able to manage it. It doesn't matter. None of this matters, and that's why ultimately the dollar down and all the rest of the trades that we've been promoting here will continue to work over the longer term. In the near term, there's some suspicion here that you could see corrections. I would say the market's going to see through this because, like I was going to say, until 2022, when everyone was late to the curve on inflation, except for us, of course, all humility aside, we were all over this. Transitory? No. We used to say waiting for Godot, the alternative ending. Because you remember, the Fed waited for inflation for years, since 2015. Inflation can be 2, inflation can be 2. It never even got there. It was always lower. Always lower. It was like waiting for Godot. And then I forget what year, I think it was 2020, early 2021, I said, waiting for Godot, the alternative ending. I think it was even a podcast title. When I said, Godot's going to show up, meaning inflation is going to come. And no one expected it to. But every other time, in my entire career, the market is always more right than the Fed, ultimately in projecting where interest rates are going. It's that simple. Why? Because the Fed, no disrespect, I wouldn't want that job, the hardest job in the world. Got a lot of respect for them. On the other hand, let's call a spade a spade. Let's call an egghead an egghead. Let's call a diamond a diamond. Let's call a heart a heart. Let's call a club a club. Let's call an egghead, an academic with no skin in the game, no blood, no foul. It's really about exercise. Remember what the Fed, Chairman Powell said. At the end of the day, this is all a big exercise to these guys. The one position I'm still holding right now is long silver. Might add gold in here. Could change very quickly. I like energy. Distillates in particular, very low supply. They're building, but it's a race against time. We'll see. Heating oil could be a big story later in this winter. And I would continue to look at, and I just did a special, which you can also get if you want to email me, on the dollar. Okay. I mean, the number of currencies breaking multi-year, multi-decade trends against the dollar is, it's a plethora of currencies. It's a very long list of currencies. Emerging markets, main currencies. It's currencies all over the world. Major long-term breakouts against the U.S. dollar. That is still the big story. Silver and gold at new highs, still the big story. As far as the rest of it right now, it's a little tricky. So I think that, having a higher degree of cash, even as the stock market breaks out, not necessarily the worst thing in the world. Follow me on Twitter, at Weldon Live, the podcast, at Money_podcast. We're on Buzzsprout, and we are available everywhere. I'm also on YouTube, users/Gregory_Weldon. And for any information on our services, we do a daily research with recommendations in all the markets, fixed income, foreign exchange, global stock indexes, all regulated futures contracts, ETFs we talk about a lot about, and we do discuss the individual stocks, although we can't officially recommend them specifically. We give you rankings on the best mining shares and these kinds of things that have really played out extremely well in the 3 years that we've been doing this, as we discussed at the beginning. For any information on any of that, including my CTA business as a registered 3 commodity trading advisor who manages individually managed accounts, money is in your name, nobody touches it, nobody commingles it, so on and so forth. Never see me on American Greed. Email me, Greg Weldon, GregWeldon, at Weldon Online. And thank you so much for listening.